Pleasure to be your host for today's Refinitiv Perspectives live stream. COVID-19 has undoubtedly transformed the risk and compliance space, and according to a recent global survey conducted by Refinitiv amongst compliance and regulatory professionals, it has significantly increased customer and third-party risk. Organizations are really struggling to dedicate the right resources to conduct know your customer or KYC and due diligence checks, allowing criminals to have more and more opportunities to engage in illegal activities. So to discuss and elaborate on some of these key findings and to talk about the latest risk and compliance trends, I'm really excited to welcome three guests today. Benjamin Katz, Policy Analyst for Extractive Industries at the OECD Center for Responsible Business Conduct, Phil Cotter, Global Head of Customer and Third-Party Risk Solutions at Refinitiv, and Debolina Guha Majumdar, Principal for AI Data and Automation Advisory at Infosys Consulting. Welcome all.
Thank you, Trang.
Hi, Trang. Nice to be here.
Great to be here, Trang.
Thank you so much, all three of you, for joining us today. And as I mentioned in my introduction very briefly, the survey that we've conducted has revealed that third-party and customer risk have been increasing significantly during the pandemic. So I wanted to turn to you, Phil, first to perhaps elaborate on the how and the why for this finding.
Yes, sure, Trang. I think there's probably a combination of things. First of all, of course, the pandemic forced everybody to adapt to working from home and virtual working, etc. And I think for a lot of organizations, particularly in their compliance and risk functions, they didn't really have the systems that allowed them to do that effectively. So I think that certainly had an impact on their processes and how they were able to maintain the appropriate kind of risk controls. I think also, of course, the pandemic's driven an acceleration of the digitization of all parts of industry, but particularly customer and supplier onboarding, for instance. And again, I think it comes through from our report that it was very clear that not everybody had the necessary technical and data capabilities to be able to do that safely. And then finally, of course, criminals never miss an opportunity, and we know that they were exploiting the pandemic. I think here in Europe, Europol issued several notices around organized gangs who were exploiting the early stages of pandemic with fake PPE supplies and defrauding companies, and then more recently warnings about fake vaccines. So I think it was a combination of those three, but I think probably the biggest factor was the virtual working and the digitization impact.
Thanks, Phil. And I think I'll come back to the really impact on managing cybercrime. And I think remote working arrangements have really kind of affected that. But I wanted to check with you, Ben, what are your thoughts on the biggest risk that the pandemic has unearthed in terms of global supply chains, and how can these challenges be better managed?
Sure, thanks, Trang. Yeah, I mean, I think when it comes to supply chain risks, at the Center for Responsible Business Conduct at the OECD, our standards on responsible business conduct really look at the way that businesses may be causing, contributing to, or be linked to risks on people, society, and the environment, really, that are external to the firms, as opposed to ESG, which is looking at how those risks impact firms internally and maybe financially material. But of course, we see an interplay here. And I think everyone would acknowledge that both lenses are really important for resilience of global value chains, which have clearly been under stress. So we've certainly seen, especially on workers throughout the pandemic, major impacts, human rights impacts stemming from economic disruptions that then kind of get cascaded onto the most vulnerable and have the most serious impacts on the most vulnerable. And of course, that has been in parallel to major disruptions in the physical sort of side of supply chains in terms of security of supply. And I think this has come to the fore as more policymakers become aware of the importance of critical materials and essential goods. I mean, I think this was most under the microscope in terms of their relevance to medical supplies during the pandemic. But we also hear about it in the context of the low carbon transition and critical minerals. And I think those kinds of, we have to be aware of those impacts We have global benchmarks like the OECD RBC standards to address them. And I think in terms of trying to turn this into an opportunity for companies and for countries, of course, industrial policy can play a role in growing countries' participation in global value chains. But of course, to really make supply chains and value chains more resilient, the research that we've carried out, which I think mirrors some of the findings of Refinitiv's report, is that increasing the diversity of sources of supply really is the best recipe for improving resilience. But in order for companies to stay engaged, across the full spectrum of sources of supply, including in high-risk countries, they need to conduct due diligence. They need to do KYC checks throughout their supply chains, and the RBC standards can really help them do so, as well as just maintaining visibility over potential risks and anticipate future disruptions.
Thanks, Ben. And yeah, I mean, great insights around supply chain disruptions and increasing economic inequalities that have, again, exposed the human rights issues that often are a big challenge for companies around the world as I guess supply chains are becoming more and more complex. Phil, do you want to add anything to Ben's thoughts on supply chain issues?
No, I agree with what Ben said. And in fact, what we're seeing from a lot of our customers is a renewed focus on the due diligence in their supply chain, particularly around things like labor rights. And obviously, people now concerned, and particularly, again, as Ben said, I think this is a risk that will continue to be with us, right? We've seen this economic downturn. People who are desperate for work and for money are also at risk of obviously being exploited. So, yeah, we're seeing a focus on human rights. Obviously, environmental exploitation is also is becoming more important. Any signs that suppliers are in any way damaging the environment as part of delivering their services or goods is becoming important. Cybercrime is becoming very important as well for customers. So yeah, we see a very similar landscape at the moment.
And a really good point made by you, Phil, around expectation for a so-called green or sustainable recovery post COVID-19. And I think the question is really asked by a lot of people around what this actually means. But I think I wanted to also touch on the recent, regulatory developments in this space and how that's impacting companies around the world. And Debolina, I hope we have you back here because this is a question I wanted to kind of turn to you first with. Regulatory trends, what are your thoughts?
So on the regulatory side, we have seen, in retail banking and across banking, something called high cost credit. So FCA came up with that so that banks can really evaluate and measure risk and not provide non-value add products and services to the customers. So what it does is high cost credit provided, that assurance, and FCN showed 150 million of savings in UK by ensuring that customers are provided though personalized interest rate, measuring their risk and compliance part, but not providing non-value add products and services to them. The other thing which during pandemic became, quite relevant was something which, again, in UK, we have seen FCA providing is called breathing space. So customers really going through hardship struggles. They can be measured against their, indebtedness and a balance towards their difficult situation. And banks and financial services came in to provide what is called a breathing space. So they can stop all interest fees and charges for that period of time so that customers can kind of improve their financial health and get back on their feet. So these two are some of one of the closest to regulations which FCA ensured, especially during the pandemic.
Thanks so much for walking us through that, Debolina. I don't know, Ben, do you want to add anything to this question?
Yeah, I mean, I think it's a trend that predated the pandemic, certainly, but I think the pandemic, as we've seen with the risks that have been accentuated during it, maybe provides even more impetus to sort of continue with this regulatory trend. But I think basically, there is an emerging rules-based system for human rights, due diligence, not only human rights, but environment and corruption and integrity risks, essentially kind of the RBC suite. It's not only in a regulatory sense, but also it's becoming a basic market expectation. We see exchange requirements like at the London Metal Exchange coming on board that use OECD standards and some other international norms on responsible sourcing in order to ensure that there's a common benchmark. And actually, in the exchange context, the commodity exchange context, that's helpful for liquidity, because when and the flexibility and smooth running of exchanges, because when there are doubts about human rights or other kinds of risks affecting or tarnishing a product, then the market kind of tries to bifurcate, tries to parse clean from dirty supply. And of course, that's an oversimplification. I think if good faith, progressive, risk-based due diligence is carried out, then companies should be able to stay engaged in high-risk countries. And those kinds of requirements at the exchange level, making due diligence a basic market expectation, can help them run more smoothly. But certainly, we had the U.S. Dodd-Frank Act and Section 1502 10 years ago now, and recently the European responsible mineral sourcing legislation on the same metals. But we also see a draft battery regulation at the EU. We see work on sector agnostic due diligence, the French duty of vigilance law. So they're really proliferating. And I think as long as we're using the same benchmark and we can create a level playing field for companies to engage in due diligence, then I think it's positive. But of course, due diligence isn't just compliance. We have been carrying out some other research ourselves on uptake through disclosure of due diligence, and we have found that while many companies are now have responsible mineral sourcing policies or other RBC policies, their disclosure on the specifics of how they're managing risks, they tend to be quite weak. And so that's something that I think as stakeholders and business people and actors collectively, we do need to be aware of the importance of really sort of where the rubber meets the road, and not just having policies, but actually, specifically identifying and managing risks.
Thanks, Ben. That's a really good and comprehensive, I guess, summary of responsible sourcing. And I'm glad you kind of touched on the environmental issues as well, because I know, Phil, you and the team have been working quite extensively on the issue of green crime and environmental crime. And I thought this could be a good opportunity to ask you more about that and what this really means for risk management at companies.
Yes, thanks, Trang. I mean, building on what Ben said, really, we coined the phrase green crime probably a couple of years ago at the World Economic Forum. And it was a term really that we wanted to use to encapsulate the kind of risks that, as we move to a more sustainable financial environment, this is what companies will need to focus on more than they have done in the past. And so, to give you some examples of what we've been doing, I mean, we've been building up our research capacity in areas like human rights, wildlife trafficking, dual-use goods and minerals, for instance. All of those are really important areas that I think more and more organizations are going to need to focus on in the future. And we've also been partnering with a number of organizations. So, we partnered with the United for Wildlife, which is the patron who is Prince William, and we're working with a number of banks and a wide range of logistics companies to, how can we help them improve their due diligence capabilities and make sure they have the data required to be able to identify risks associated with wildlife trafficking. And we've also partnered with a number of other organizations to help us be able to gather information about ESG related controversies. And I think to Ben's point, this is not about the indices and what you self-report or, what other people have a view on. This is really detailed information about, what are the labor practices on the ground? What are the environmental practices? What other issues are there from a sustainability perspective that you need to be concerned about as an organization? Because I do think that whilst regulation is clearly got a role to play in this, one of the things I'm encouraged by is a lot of customers I'm speaking to really see this as an important part of, their brand and how they're going to protect the reputation of their business in the future.
That's a really great point, Phil, and I think it aligns with one of the key findings from the survey that really, I think the pandemic and I think everything that's been happening in the past, 12 months has shown a greater awareness of environmental, social, and governance, or ESG issues, and also green crime, as you mentioned. And I was wondering, Debolina, what's your opinion? Like, will this lead to, a transformation on how businesses go about managing their ESG risks and also opportunities?
Definitely. I think what the pandemic did is it really brought forward, at the forefront of every discussion, the importance of sustainability and responsible business and the entire ESG spectrum. So I know that, banks are really focusing on responsible banking part. So it's not just about, that we are showing, say, for example, based on ESGs, as outlined by a World Economic Forum and their recent framework that, people, planet, and governance. Under the people part, you need to really demonstrate the gender equality part. So whether there are gender pay gaps, and how is your diversity index or equity index in the companies. In the planet part, how are you managing waste? Are you really dumping waste in a third world and showcasing the numbers? And the governance part, definitely, like how have you embraced stakeholder capitalism? Are you still focused on just shareholder returns and not focusing on your suppliers, your customers, the entire community and the planet? So it's very important, I think, from the entire ESG sustainability and stakeholder capitalism part that you have the data and how you are refining the data and reporting it, how true is your representation in those reports. That is fundamental. And that is where I think the entire data AI comes into space and how ethical and explainable they are to depict a true sustainable picture for the company.
Thanks, Debolina, and I will come back to you on the ethical AI topic because I know that's something that's been really, trendy and also something that we should obviously pay more attention to. But I know, Ben, ESG is also a big, part of your role and your responsibilities. Is there anything you wanted to add? Because I think what the question I receive all the time is that kind of surface level reporting versus, real data and not just compliance, but really showing true commitment to sustainability. What are your thoughts there?
Yeah, I think that, this is where it becomes interesting trying to parse out, what ESG relates to and what RBC relates to. And really, in many ways, while they have somewhat different risk scopes, in that sense, the risk scope part, they're really very similar. But I think the distinction between them relates more to the lens you're taking to address those risks. I think that ESG, clearly can be a very effective way to channel finance to and allocate finance to uses that may be more responsible, may have a positive impact, may have less of a negative impact on many of the issues that RBC relate to. But I think we need to a little bit of a better, to better define in some cases what we mean by ESG. And this is actually an area that we're increasingly interested in at the OECD in terms of trying to see, what are the outcomes of ESG policies as opposed to RBC policies? How do they relate to each other? And of course, data plays a major role there. Trying to better understand, what ESG comprises, what ESG ratings comprise. How do we sort of compare them? Are we comparing apples to apples? I think that's really relevant, to the whole resilience narrative and discussion post-pandemic as well, because in order to improve resilience, of course, revolving finance plays a really important role in commodities trading and essential goods and critical materials. And we have seen a number of cases recently where banks are rewarding traders for meeting KPIs on responsible sourcing. And so I think even more so during times of disruption, of course, secure access to finance is a really important ingredient to stay afloat. So I think getting that data and seeing how ESG lines up with RBC and how we can kind of make that data understandable in a way to improve the way ESG channels finance. I think that's a major interest of ours, but a lot more to be done in terms of the data and the research.
Great insights, Ben, especially around the connection between ESG and responsible business, and also the issues around quality data, but also comparable data, because I think that's a big, challenge a lot of financial institutions and investors have mentioned to us as well. So tons of, food for thought. But I wanted to move on to another big topic of the survey that we've conducted, which is really around technology. And it's something that I think we've kind of unearthed as a key finding in the past couple of years that we've been doing this survey, that financial institutions are increasingly embracing technology to detect financial crime. And I just wanted to turn to you, Debolina, because I know this is a big focus of your role, on how these different technologies like AI, machine learning, big data, how can they help us create a safer world?
Sure. So AML, I would say that, is absolutely a topic which is close to my heart. So, and AI, data, ML, all of these are becoming fundamental for AML now. So how we look into, the analysis, like what used to be earlier was, people would put up a form and all was based on human judgment. Someone would go through the forms, analyze and say whether it's a financial crime or not. And this is where AI comes in. So all banks and organizations have a transaction monitoring system, and they are now overlaid with different AI models and, ML. There are business rules which are also plugged in. So, we look at it at 4 layers. So first layer is, you do the business rules, you identify whether it's a crime or not. Then you have a behavioral layer. So, there are some very common behavioral traits, and the AI model detects those behavioral and try to make the judgment or prediction based on that. The third one is what we call is supervised machine learning. So in supervised machine learning, you are basically the AI system is fed with, historic data, and it kind of tries to make the judgment and prediction based on the training historic data that the system is fed with. And finally, what we have is like unsupervised machine learning, where it really, like, the system is truly intelligent, looks for the strange unknowns and the outliers. And that is where I would say that technology had made a very, very fundamental leap, because these were never getting picked up. And now, we truly have intelligent systems to pick for that.
Great insights. Phil, I think this is a topic that's also close to heart for you. Do you want to add anything to what Debolina already mentioned?
Well, first of all, I agree with what Debolina said. I think, AI is helping to make it, the identification of risk more efficient and more effective. But I think, there's a few things that anybody thinking about deploying AI needs to understand. The first thing is, it's only as good as the quality of your data. Okay, and it takes a lot of effort to get your data into good shape. I think that's the first thing. I think the second thing is, this is still relatively new from a regulatory perspective, and so I think you need to make sure that when you're deploying AI, you're in conversations with your regulators. You're making sure that they're comfortable with the way that you're approaching it. They certainly don't like black box type AI where you can't explain why the decisions were made. So I think that's also important. But clearly, it does hold out the opportunity for, as I say, a much more efficient and effective approach to identifying the types of issues that we've talked about, both in terms of sustainable finance and AML and bribery and corruption, etc., which are all risks that our customers are faced with. So, it's I still sometimes, although we've talked about AI for a long time, I still feel we're still at the very early stages of rolling this out, and there's more to come. But it's certainly something that I think we're clearly going to see more and more organizations deploying over time.
Great insights, and I think that feeds into something, Debolina, I know you wanted to talk about, is really around ethics and AI and really kind of accounting for how these decisions are made. Do you want to comment on that quickly?
Sure. So, as with technology really at the forefront of everything and AI making decisions, how the AI is built and how ethical and explainable is the AI is very important. Because as we have seen that, even companies like Amazon built a recruiting system AI, which was completely, outlining the women candidates and not choosing them, or going over to Google computer vision, which was identifying different race as couldn't verify people from minorities, ethnicities, and race. So it's very, very important with how we have built the system. So there are three parts to an ethical AI, and especially in banking now, that we are trying to personalize the offers and credit allocation, because credit allocation and how we evaluate risk is we look into a person's, a measure of indebtedness, income, affordability, etc., which is fine, which is risk-based pricing. But with the AI systems, we also know, your gender, your race, which locality you live, and what skincare products you use. So they indirectly know every data. So it's a very fine line how your system is built. We have to be very vigilant that whether we have a diverse team who is creating those systems and bringing those diverse thinking, what training data sets we are feeding into the system so that it can, really not picking up the biases that we have for centuries. Like in credit allocation, we all know the concept of redlining, how credit was given to a certain section of the society, and we created segregated neighborhoods. And, we never included minorities and other ethnicities for financial inclusion. So it's very important when we are building these AI systems who are now the judge for credit allocation, that they are fair, transparent, and it's providing, a true trustworthy picture and pricing.
Mm-hmm.
Thanks, Debolina, and ultimately goes back to the same fact that Phil touched on as well. It's the machines making the decisions, but I think the humans building these machines still matter a lot. So thanks for sharing that. I know that you have to rush off to another meeting, so I'm going to go to my final question, which is really around lessons learned from the pandemic, because the survey has really unearthed two key findings that was actually quite surprising for me. One being that 65% of our respondents believe that they had to actually take shortcuts in their KYC and due diligence checks because of the pandemic. And the second one, saying that I think almost 2/3 of them said that cybercrime was much more challenging to be contained because of the remote working arrangements, again, caused by the COVID-19. So, Debolina, I think I'm going to go to you first on what your thoughts are on these findings and what does really the future hold for risk and compliance post-pandemic.
I would say that, post-pandemic, with pandemic, we have really learned how, all moved to a new ways of working. We use technology much more for our identity verifications and everything. So cloud migration has really, really enabled those. But post-pandemic, I think we have to be vigilant on the human part as well. So collaboration, as your report states, is quite fundamental, whether how we are collaborating, how we are building that resilience, what technology are we using, and those technologies, are they ethical? Are they, can they explain themselves? So all of this, I think the pandemic has really taught us. We have enabled organizations to move their, the customer service centers overnight to a cloud-based remote working. We have enabled organizations to this new ways of working. Everything we were doing in person, now we have different tools and technologies that, we are doing from home. But I think that that human connection is still fundamental, and it's fundamental to building businesses and everything. So I think we need to be a balance and how we use technology, how we evaluate risk and everything with the collaboration part keeping in mind.
Yes, so human connection and collaboration. Thanks for sharing that, Debolina. I know if you have to drop, that's absolutely fine. Thank you so much for being here with us today. And I think, Ben, do you want to share your thoughts on the question?
Sure. I mean, I think we found something similar in some of we did research and consultations among our stakeholders on due diligence and due diligence systems' ability to withstand the pandemic. And I think what we found, which also recalls what Phil was saying earlier, is that their due diligence systems were tested during the pandemic, partly because there were in-person engagements that moved to remote engagements. But I think if due diligence system, what we did find was that due diligence systems that were strong prior to the pandemic, that already had strong elements of supplier engagement, really going through the supply chain, then those systems, even when they did have to adapt and move from in-person to more virtual or remote, they were able to adapt and withstand the challenges much better than systems that were more ad hoc or kind of only engaging when there was a really acute risk as opposed to on a proactive, ongoing basis. So yeah, I think that was one of our main takeaways, that having strong due diligence management systems to begin with does help companies better withstand disruptions when they do occur, whether that's on issues in terms of risk visibility and disruptions and impacts on the company, as well as impacts on people, society, and the environment.
Thanks, Ben. And yeah, I guess the pandemic was in many ways is a great stress test for systems and processes. And Phil, do you agree? And were you surprised with the findings that I guess I mentioned earlier?
Was it surprised? Not particularly, because I know that a lot of our customers were, trying to adapt to this new environment. And I think, as Ben said, as we can see in the way that governments are focused on rolling out vaccinations, right? It was about what are the key risks that I really need to manage and how do I focus on those? And I actually think a lot of organizations did a really good job around there. I think one of the things that when we look back on this pandemic, we will actually probably marvel about is actually the resilience of the global supply chain. Right, despite all of the challenges, right, the global supply chain was able to stand up and continue to, support the world and ensure that the majority of people, got access to the food and services that they needed. But what I do think that organizations are going to have to consider, and particularly with some of the regulatory trends and some of the other things we've talked about recently around sustainable finance, is they are going to have to consider how are they going to go back and kind of remediate and refresh the risk profile of some of those organizations or customers where they perhaps didn't do as much due diligence as they would have done under normal circumstances. And again, I'm already beginning to see some trends within our own customer base where people are starting to do that, particularly with some of the suppliers that they onboarded during the pandemic to help with the resilience, but now going back and just making sure that they're covering all of the risks that they need to.
Thank you, Phil. And again, thank you to the both of you for all the valuable insights and information shared. I really enjoyed our conversation, but I think time is up. So thank you for being with us here today, Phil and Ben.
Thank you, Trang.
Pleasure to be here.
Thank you. And for anyone that wants to find out more about these risk and compliance trends that we've discussed, we actually have the Risk and Compliance Global Report downloadable with the QR code on screen now or through the link in the chat. So I encourage you to take a look. It's really an insightful read. Thank you so much for being here with us today and see you at our next live stream. Take care.